Most people believe the strength of the United States comes from our aircraft carriers, our nuclear arsenal, or the Silicon Valley tech giants. But those people are wrong. For the last 50 years, the true source of American power hasn't been gunpowder or code. It has been a handshake deal made in the desert in 1974. A deal that forced the world to buy our debt, fund our deficits, keep our interest rates artificially low. But yesterday that deal died. And when the foundation of the global financial system cracks, you don't just patch it up with a press release, you prepare for an earthquake. First, let's be clear about what just happened in Riyadh. Saudi Arabia didn't just sign a trade agreement. They fundamentally rewrote the operating system of global commerce. They have officially signaled that the exclusivity of the US dollar for oil trade is over. They are now accepting Chinese Yuan and Gold for their black gold. This is the financial equivalent of a nuclear detonation. When Ray Dalio, the man who built the world's largest hedge fund and understands macro cycles better than any Federal Reserve chairman, says the U.S. debt crisis starts now, you stop what you are doing and you listen. This isn't cable news hyperbole. This is math. Now, I have spent 7 decades in the markets. I remember the world before the petrodollar. I remember the chaos of the early 1970s when Nixon closed the gold window. I saw the inflation, the gas lines, and the panic. And I can tell you that what we are staring down the barrel of right now makes the 1970s look like a dress rehearsal. For 50 years, we have lived in a bubble of privilege. We printed money, and the world accepted it because they needed it to buy energy. That demand for dollars allowed us to run deficits that would have bankrupted any other nation. It allowed us to fight wars on credit cards and buy cheap imports with paper money. That era ended this morning. This isn't just about oil prices. Don't make the mistake of thinking this is a commodity story. This is a currency story. It is a sovereign debt story. It is a story about whether the money in your savings account will hold its value when the artificial demand for it evaporates. When Saudi Arabia says, "We will take yuan," they are telling the world that the US dollar is no longer the only game in town. They are telling central banks from Brazil to India that they don't need to hoard US Treasury bonds anymore. And when nobody wants to buy our bonds, the interest rate on our debt goes vertical. Ray Dalio calls this the big cycle. It's the moment when an empire overextended by debt and internal conflict loses its reserve currency status. It happened to the Dutch. It happened to the British. And now the indicators are flashing red for the United States. The Saudis aren't doing this because they hate America. They are doing it because they can count. They see a U.S. government that is $35 trillion in debt. They see a Federal Reserve that has printed trillions of dollars out of thin air. They see a weaponized financial system that seizes assets of countries it disagrees with, and they are deciding to diversify. It is a rational business decision for them. It is a catastrophe for us. Let's go back to 1974 to understand the gravity of this. Henry Kissinger struck a deal with the House of Saud. The U.S. would provide military protection and weapons. In exchange, the Saudis would price oil exclusively in U.S. dollars and plow their profits back into U.S. treasuries. That was the magic trick. We bought their oil with dollars we printed, and they used those dollars to buy our debt. It was a perpetual motion machine of American prosperity. It meant that inflation was exported to other countries while we enjoyed cheap capital. It was the greatest economic advantage in history. But that machine is broken. The gears have ground to a halt. When Saudi Arabia accepts gold, they are choosing a neutral reserve asset that cannot be printed by the Federal Reserve. When they accept yuan, they are aligning themselves with the world's factory, China. This is a geopolitical pivot that shifts the center of gravity from the Atlantic to the east, and the markets are already sniffing it out. Gold is hitting all-time highs not because people like jewelry, but because smart money is fleeing fiat currency. They see the writing on the wall. Washington isn't ready for this. Our politicians are arguing about social issues and tax brackets, completely missing the tsunami approaching our shores. They assume the demand for U.S. debt is infinite. They assume we can run trillion-dollar deficits forever because we are the United States. That arrogance is our Achilles heel. The bond market doesn't care about your flag. It cares about supply and demand. And the biggest buyer of our debt just walked away from the table. Think about the sheer volume of trade we are talking about. The global oil market is massive. If even 20% of that trade shifts away from the dollar, that is hundreds of billions of dollars that are no longer needed by foreign central banks. Where do those dollars go? They come home. They flood back into the domestic U.S. economy. And when too much money chases too few goods, you get inflation that interest rate hikes cannot fix. You get a devaluation of the currency that makes your grocery bill look like a mortgage payment. Dalio's warning about the debt crisis is specific. He isn't talking about a default where the government stops paying. He is talking about a crisis of confidence, a crisis where the only way the government can pay its bills is by printing money to buy its own debt because the Saudis and the Chinese aren't buying it anymore. That is the beginning of the end for a currency's purchasing power. We have seen this movie before in emerging markets. We call them banana republics, but Americans think it can't happen here. I'm here to tell you the laws of economics apply to everyone, even superpowers. The shift to the Petroleum or Petrogold is not something that will happen in a decade. It is happening now. The infrastructure has been built. The cross-border interbank payment system, CPS, in China is ready. The Shanghai Gold Exchange is active. The Saudis have the mechanism to bypass New York entirely. This removes the sanctions leverage the U.S. has held over the world. If you can trade energy without touching the U.S. banking system, you are immune to U.S. financial pressure. That changes every diplomatic calculation in the Middle East and beyond. What makes this truly dangerous is the speed at which trust can evaporate. Money is a confidence game. The U.S. dollar is a fiat currency. It is backed by nothing but the full faith and credit of the United States government. When that credit is over-leveraged and that faith is shaken by a geopolitical divorce from the energy sector, the value proposition collapses. Investors hate uncertainty, and there is nothing more uncertain than a debtor nation losing its banker. We have spent decades weaponizing the dollar. We used it to punish Russia, Iran, and Venezuela. We thought we were invincible, but weaponizing the global reserve currency incentivized our adversaries to build an alternative. And now, our allies, the Saudis, are joining that alternative. They are hedging their bets. They are saying, we will sell to whoever pays in whatever currency works. That is the free market at work, but it is a market that works against American hegemony. You need to understand that this isn't just about oil. Oil is the most traded commodity in the world. It sets the baseline for shipping, for manufacturing, for agriculture. If oil is priced in a basket of currencies, then the dollar loses its special status. It becomes just another currency among many. And if the dollar is just another currency, then the United States is just another country with a bad balance sheet and a dysfunctional government. We lose the exorbitant privilege that allowed us to live beyond our means for 3 generations. I watched the Treasury auctions. These are the boring meetings where the U.S. government sells its debt to fund the military, Social Security, and interest on the debt. Lately, those auctions have been getting ugly. Tail risks are appearing. Bid-to-cover ratios are dropping. This is technical speak, for nobody wants to buy this stuff at this price. And that was before the Saudis made this announcement. Now the Federal Reserve is the buyer of last resort, and that is a trap. The media will try to downplay this. They will say the dollar is still strong relative to the euro or the yen. And that might be true in the short term. But that is like being the cleanest shirt in the laundry hamper. It doesn't mean you are clean. The structural shift is undeniable. The monopoly is over. We are moving to a multipolar financial world. And in a multipolar world, the United States cannot dictate terms. We have to compete, and we are not in competitive shape. This is why Dalio is sounding the alarm. He knows that debt cycles end in one of 2 ways: hard default or soft default. A hard default is bankruptcy. A soft default is inflation, paying back your debts with money that is worth half of what it was when you borrowed it. The pivot away from the petrodollar guarantees that we are heading for the soft default. Inflation is the only way out for Washington. They will sacrifice the value of your dollar to save the bond market. This is the raw truth that Wall Street whispers about, but rarely shouts. The system relies on constant expansion of credit, but credit requires a willing lender. The Saudis were the ultimate willing lender for 50 years. They are closing the checkbook. They are taking their business elsewhere. And the vacuum they leave behind will be filled by volatility, higher rates, and economic pain for the American consumer. The silence from the White House is deafening. They know they have lost leverage. They know they cannot force the Saudis back into the 1974 deal. The geopolitical reality has changed. China is Saudi Arabia's biggest customer now, not the United States. Money talks, and right now the money is speaking Mandarin and shining like gold. We are witnessing the passing of the torch, not voluntarily, but out of necessity. I've seen empires decline. I watched the British pound lose its status. It didn't happen overnight, but it happened steadily, and the quality of life for the average Briton declined with it. We are on that same trajectory. The petrodollar was the dam holding back the floodwaters of our fiscal irresponsibility. The Saudis just blew up the dam. Now we have to learn how to swim in a flood. Now, Let's get into the plumbing of the financial system, because if you don't understand the mechanics, you can't understand the magnitude of the risk. Most people think the price of a bond is just a number on a screen. It's not. It is the price of money. It is the price of risk. And when the Saudis stop recycling their oil profits into US Treasuries, the mechanics of the global bond market break down. This is what we call a liquidity crisis in the making. But on a sovereign scale, for decades, we relied on a mechanism called petrodollar recycling. Here is how it worked. Saudi Arabia sold oil to the world and received US dollars. They had more dollars than they could spend in their own country. So what did they do? They bought US Treasury bonds. They effectively loaned the money back to the US government. This created a constant massive bid for U.S. debt. It kept bond prices high and interest rates low. It allowed Americans to get 3% mortgages. It allowed the U.S. government to borrow trillions at near zero interest. That cycle is now running in reverse. If Saudi Arabia accepts yuan, they aren't buying treasuries. They are likely buying Chinese bonds, or more likely buying gold. If they accept gold, that capital completely exits the fiat debt system. This removes the automatic buyer from the treasury market. When you lose the biggest whale in the market, the price of what you are selling crashes. In the bond market, when prices crash, yields say interest rates spike. Ray Dalio focuses heavily on supply and demand in the debt markets. Right now, the US Treasury is issuing debt at a record pace. We are running a deficit of nearly $2 trillion a year. During peacetime, we need to sell a mountain of bonds every single month just to keep the lights on. But supply is skyrocketing just as demand is falling off a cliff. The Saudis are out. The Chinese are selling, not buying. The Japanese are struggling to support their own currency and can't buy as much. Who is left? This is where the mechanics get scary. When foreign nations stop buying our debt, the interest rate on that debt has to rise to attract other buyers. We have to bribe investors to lend us money. We have to offer 5%, 6%, 7% yields on the 10-year treasury. That sounds great for a saver, but it is death for a debtor. And the biggest debtor in the world is the U.S. government. If interest rates rise to 6% or 7% and stay there, the interest payments alone on the national debt will consume the entire federal budget. Let's talk about the Troy one. This isn't just a fantasy. The Shanghai Petroleum and Natural Gas Exchange is already processing trades. The Chinese have set up a convertibility trap that is actually brilliant. They told the Arab nations, "We will pay you in yuan. But if you don't trust the yuan, you can immediately convert it into physical gold on the Shanghai Exchange." This bypasses the trust issue. The Saudis don't need to trust the Chinese Communist Party. They just need to trust gold, and everyone trusts gold. This links oil to gold, effectively recreating a gold standard that excludes the dollar. This mechanical shift definancializes the oil trade. The U.S. dollar system is highly financialized. It relies on banks, SWIFT codes, and digital ledgers. The gold-yuan route is a move toward hard assets. It is a rejection of the paper promises of the U.S. Treasury. I have watched asset classes rotate for 70 years. When capital moves from paper to hard assets, it is usually because the paper is about to burn. The impact on the U.S. banking system cannot be overstated. U.S. banks hold trillions in treasuries as safe collateral. We saw what happened in 2023 when banks like Silicon Valley Bank collapsed. Why did they collapse? Because the value of their bonds dropped as rates rose. Now imagine that on a systemic, national level, if the Saudis exit pushes rates significantly higher, the unrealized losses on U.S. bank balance sheets will explode. The banking system is technically insolvent if they have to mark those bonds to market. This is why Jamie Dimon and other banking CEOs sound so nervous. They know the plumbing is clogged. They know that without the petrodollar flow, the liquidity that greases the wheels of Wall Street dries up. Liquidity is like oxygen. You don't notice it until it's gone, and then you choke. The repo markets, the overnight lending markets, all of these depend on stable treasury collateral. If treasuries become volatile because the Saudis are dumping them, the entire credit mechanism of the U.S. economy seizes up. And what about the derivatives market? There are hundreds of trillions of dollars in derivatives tied to interest rates. A sudden, uncontrolled spike in yields caused by a geopolitical shock can trigger margin calls that no one has the cash to meet. This is the financial accident that the Fed fears most. They can print money, but they cannot print trust. If the world decides that the U.S. Treasury bond is no longer the risk-free asset, the foundation of all pricing models collapses. The Saudis understand leverage. By dropping the dollar, they are effectively shorting the U.S. economy. They are betting that the U.S. cannot get its fiscal house in order. And look at the data. They are right. The U.S. is trapped. We cannot raise taxes enough to cover the deficit. We cannot cut spending without political suicide. So we must issue debt. But without the petrodollar recycler, issuing debt creates a feedback loop of higher rates, which creates more debt, which creates higher rates. It is a death spiral. China's role here is calculated. They aren't trying to replace the dollar with the yuan as the global reserve currency overnight. They don't want the burden of running trade deficits. Instead, they want to fracture the system. They want a fragmented world where the dollar is just one option among many. This dilutes U.S. sanctions power. If China wants to buy Iranian oil, they can do it in yuan. If Russia wants to sell to India, they can do it in rupees or gold. The network effect of the dollar is being dismantled node by node. Dalio talks about the internal conflict and external conflict phases of the cycle. We are seeing them merge. The external conflict loss of petrodollar will exacerbate the internal conflict inflation and wealth inequality. When the mechanism of cheap imports breaks down because the dollar weakens, inflation returns. When inflation returns, social unrest rises. It is all connected. The mechanics of the currency are the mechanics of society. Let's look at the sheer logistical shift. Tankers leaving Ras Tanura in Saudi Arabia used to carry oil priced in dollars, insured by Lloyd's of London and financed by New York banks. Now, those tankers are heading to Ningbo, priced in yuan, insured by Chinese firms and financed by state-owned Chinese banks. The entire service economy surrounding the oil trade, legal, insurance, banking, is migrating east. That is a loss of high-paying American jobs that no tariff can bring back. The exorbitant privilege I mentioned earlier allowed us to make mistakes. We could have a housing crisis in 2008, print our way out of it, and the world still bought our bonds. Why? Because they needed dollars for oil. That safety net is gone. The next time we have a financial crisis, and we will, the Fed cannot simply print $5 trillion without collapsing the currency. If the world doesn't need those dollars for oil, they will just sell them. This turns a recession to a hyperinflationary depression. I don't say this to scare you. I say this because I respect the mechanics of the market. The market is a machine. If you remove a critical gear, the petrodollar, the machine works differently. It grinds, it overheats, it breaks. The 1974 deal was the lubricant. Without it, the friction in the U.S. economy is going to increase dramatically. Every transaction will cost more. Every loan will be harder to get. Every government project will be more expensive to fund. We are witnessing the repricing of American hegemony. For 50 years, we paid a hegemony discount on our debt. The world lent to us cheaper than anyone else. Now we are going to have to pay the market rate. And for a nation addicted to cheap debt, the market rate is a lethal overdose. The mechanics don't lie. The bond yield curve is screaming a warning. The gold chart is screaming a warning. And now the Saudi Ministry of Energy has picked up the megaphone. The Federal Reserve is now in an impossible box. If they lower rates to save the economy, the dollar crashes because there is no petrodollar support. If they raise rates to save the dollar, the banking system and the housing market implode. There is no Goldilocks scenario here. The pivot to yuan and gold removes the Fed's ability to control the global financial narrative. Powell is no longer the captain of the ship. He is just a passenger on a boat taking on water. This is the reality of the post-petrodollar world. It is a world of harder money, higher rates, and geopolitical competition. The free lunch is over, the bill has arrived, and the Saudis just told the waiter that they aren't picking up the tab anymore. To understand why this is a crisis of existential proportions, we have to talk about a concept that usually stays in economics textbooks but is now playing out in your living room, the Triffin Dilemma. Robert Triffin was an economist who famously predicted the end of the Bretton Woods system. He explained that the country issuing the global reserve currency has a conflict of interest. To provide enough liquidity for the world to trade, that country must run trade deficits. It must let dollars flow out so the world can use them. But running chronic deficits eventually destroys confidence in the currency. For 50 years, the petrodollar suspended the Triffin Dilemma. We could run deficits, and instead of losing confidence, the world simply recycled those dollars back to us because they had no choice. Oil was the anchor. As long as the world needed oil, they needed dollars. This allowed the U.S. government to detach its spending from its revenue. We didn't need to balance the budget. We just needed to ensure the oil kept flowing in dollars. This created a mirage of solvency. We looked rich, but we were just the world's biggest credit card user with a limitless limit. Now that the anchor is gone, the Triffin Dilemma is back with a vengeance. The U.S. is running a deficit of nearly 7% of GDP. In historical terms, that is a wartime deficit level. but we are technically at peace. We are spending money on interest, on entitlements, on defense, on subsidies, and we are financing it all by issuing treasury bonds. But the dilemma states that as we flood the world with more dollars to debt, and the demand for those dollars drops, no petrodollar lock-in, the value of the dollar must fall. Ray Dalio points to this mismatch as the catalyst for the big debt crisis. The U.S. government collects about 4.5 to 5 trillion in tax revenue. It spends over 6.5 trillion. The gap is filled by borrowing. When the Saudis and Chinese were buying that debt, the interest rate stayed low. Now we have a supply glut. The US Treasury is like a store owner trying to sell winter coats in July. Nobody wants them. So you have to lower the price. In bond terms, lowering the price means raising the yield. This creates a vicious feedback loop for the federal budget. As yields rise, the cost of servicing the debt rises. Currently, the U.S. spends more on interest payments than on the entire defense budget. Soon, we will spend more on interest than on Social Security. This is mathematical insanity. It is the definition of a debt trap. To pay the interest, we must borrow more. To borrow more, we must offer higher rates. Higher rates mean higher interest payments. It is a snake eating its own tail. Without the petrodollar demand, the Federal Reserve becomes the monetizer of last resort. This is a fancy way of saying they print money to pay the bills. When the Treasury holds an auction and nobody shows up, the Fed steps in and buys the bonds with digital cash they create on a computer. This is officially called yield curve control, or QE. But let's call it what it is: debasement. It is diluting the share count of the United States. Every dollar you worked for, every dollar in your 401k, becomes worth less because the government has to print trillions to fill the hole left by the Saudis. The political class in Washington refuses to acknowledge this. They talk about modern monetary theory, MMT, which claims deficits don't matter as long as you print your own currency. MMT works until it doesn't. It works until the world rejects your currency. The Saudi pivot to gold is a direct rejection of MT. It is a vote of no confidence. It is the world saying, we don't believe you can pay us back in anything of value. We are facing a fiscal dominance scenario. This happens when the central bank loses control of inflation because the government spending is too high. The Fed can raise rates to 20%, but if the government is printing trillions to pay interest on the debt, inflation will keep raging. The petrodollar was the shield against fiscal dominance. It absorbed the excess liquidity. Now the shield is gone. The inflation we are about to see won't be supply chain inflation. It will be monetary inflation. It will be the currency itself losing altitude. Consider the entitlement programs, Social Security and Medicare. These are unfunded liabilities. They depend on the government's ability to borrow. If the bond market balks, if the bond vigilantes return because the Saudi backstop is gone, the government faces a stark choice: cut benefits massively, political suicide, or print the money to pay the benefits, hyperinflation. There is no third option. The math doesn't allow for it. The petrodollar allowed us to pretend there was a third option. The Triffin Dilemma also predicts that as the reserve issuer falters, rival blocs emerge. We see the BRICS nations: Brazil, Russia, India, China, South Africa, and now Saudi Arabia and others forming a trading bloc that creates its own closed loop. They trade commodities among themselves using local currencies or gold. They don't need the dollar. This shrinks the network of the dollar. As the network shrinks, the utility of holding dollars drops. Why hold dollars if you can't buy Saudi oil or Russian gas or Chinese electronics with them? This leads to a repatriation of dollars. Trillions of eurodollars, so dollars held outside the U.S., will start to find their way home. When they enter the U.S. domestic economy, they bid up the price of real assets. Real estate, farmland, stocks, commodities, prices will soar not because the assets are better, but because the dollar measuring them is shrinking. We call this a crack-up boom. The stock market might go to 50,000, but a loaf of bread might cost $20. You feel richer on paper, but you are poorer in reality. The deficit is the elephant in the room that the petrodollar allowed us to ignore. Now the elephant is stampeding. The U.S. government has no plan to balance the budget. In fact, deficits are projected to grow. This trajectory is sustainable only if the world cooperates. The world has stopped cooperating. The Saudis have looked at our balance sheet and decided they prefer gold bars to treasury bills. Can you blame them? If you loaned money to a neighbor who kept spending more than he earned and printed his own IOUs, would you keep lending? Dalio warns that this phase of the cycle is characterized by loss of faith. It starts with the smart money, then the foreign central banks, then the domestic institutions. Finally, The public, we are in the foreign central bank phase. The Saudis moving to gold is the signal that the smart money has already left and the sovereigns are now moving. The next phase is when U.S. pension funds and insurance companies realize that Treasury bonds are return-free risk instead of risk-free return. When that realization hits, the Treasury market could freeze. This is why the Fed is quietly preparing tools to buy everything. They know the buyers are on strike. But the Fed buying everything is the endgame for a fiat currency. It is the Weimar Republic scenario. It is Zimbabwe. It is Venezuela. We have better institutions and a more diversified economy, so it won't look exactly like that. But the direction of travel is the same. The destruction of purchasing power is the only way to reconcile the math. The privilege is gone. We are now just a nation with a lot of debt and a printing press. The discipline that the market imposes on other nations is coming for us. We will have to choose between guns and butter. We will have to choose between defending Ukraine or paying pensions. We will have to choose between green energy subsidies or low inflation. The petrodollar allowed us to have it all. The end of the petrodollar means we have to make choices, and our political system is incapable of making hard choices. This is the macro trap. The deficit requires low rates to be affordable. The inflation caused by the weak dollar requires high rates to be tamed. You cannot have low rates and high rates at the same time. The Fed is checkmated. The Saudis just knocked the king over. The game is effectively over. We are just playing out the moves until the public realizes what happened. I've watched administrations come and go. Democrat, Republican, it didn't matter. They all spent money because the petrodollar let them. That bipartisan consensus of spending is about to hit a brick wall. The era of free money is dead. The era of consequences has begun. The Triffin Dilemma is no longer a theory. It is the headline. So, what does a diplomatic shift in Riyadh and a chart and hedge fund office mean for you, the teacher, the dentist, the small business owner in Ohio? It means everything. Because while the elites debate monetary theory, the consequences land squarely on your kitchen table. When the global demand for the dollar drops, your standard of living drops with it. This is the importation of poverty, and it is coming for the American middle class. First, let's talk about inflation. You thought 9% was bad. That was supply chain inflation. What comes next is currency devaluation inflation. The United States imports almost everything. We import our electronics, our clothes, our car parts, our coffee. We buy these things with dollars. When the dollar weakens because the Saudis and Chinese are dumping it, the price of everything you buy at Walmart and Amazon goes up. Not by a few cents, but by double digits. Your paycheck stays the same, but it buys % less. That is a pay cut that no boss announces, but everyone feels. Gas prices are the most obvious flashpoint. Even though the U.S. produces oil as a global commodity, if the dollar weakens against gold and the yuan, the nominal price of oil in dollars goes up. We could see $6, $7, maybe $10 a gallon gas, not because of a shortage, but because the paper money you are using to pay for it is worth less. Think about what 8 gas does to the economy. It crushes commuters. It bankrupts trucking companies. It raises the price of food delivery. It acts as a massive tax on every single household. Then there is the interest rate shock. Mortgage rates are tied to 10-year Treasury yield. As I explained, without the Saudi buyer, yields must rise to attract capital. We could see mortgage rates settle permanently in the 8% to 10% range. For a generation of Americans used to 3% rates, the housing market becomes frozen. You can't afford to move. First-time buyers are locked out forever. Home values, which are propped up by cheap debt, will have to correct downwards in real terms. You might see the number on Zillow stay high, but the real value, what that house can buy you in gold or groceries, plummets. Retirement accounts are in the crosshairs. The traditional 60-40 portfolio, 60% stocks, 40% bonds, is built on the assumption that when stocks fall, bonds rise, providing safety. That correlation is breaking. In a debt crisis, stocks fall because of the economy, and bonds fall because of the interest rates. Both sides of your portfolio lose money at the same time. This is what happened in 2022, and it is the new normal. If pension funds, which are heavily invested in Treasury, start taking losses, we are talking about solvency issues for retirement systems. The promise of a secure retirement is being eroded by the loss of the dollar's privilege. Credit card debt and auto loans will follow the Treasury rates. We are already seeing credit card rates over 25%. In a post-petrodollar world, capital is scarce. Banks will lend less and charge more. The credit-fueled consumption that drives 70% of the GDP will hit a wall. If you can't put it on the card, you can't buy it. This leads to a recession, a deep, grinding recession that creates unemployment. But unlike 2008, the Fed can't just lower rates to fix it, because lowering rates would crash the dollar further. This is called stagflation, stagnant growth plus inflation. It is the economist's nightmare, and it is the consumer's misery. Let's look at the social contract. The U.S. government funds huge programs, Social Security, Medicaid, defense, assuming it can borrow cheaply. When borrowing costs triple, something has to give. We might see austerity, measures that Americans aren't used to, cuts to services, crumbling infrastructure left unrepaired, longer wait times at the VA. Or more likely, the government will print the difference, leading to the Latin Americanization of the U.S. economy. This means a widening gap between the rich who own assets and the poor who earn wages. The psychological impact will be profound. Americans are used to their money being the gold standard. Traveling abroad, the dollar was king. That is changing. We are already hearing stories of merchants in some countries preferring euros or even crypto over dollars. When the prestige of the currency fades, the national psyche takes a hit. We lose the feeling of exceptionalism. We realize we're subject to the same gravity as everyone else. Small businesses are particularly vulnerable. They operate on thin margins. They rely on lines of credit. If the cost of inventory rises due to a weak dollar, and the cost of credit rises due to the bond market, small businesses get squeezed out. We will see a wave of consolidation where only the giant corporations with cash piles survive. Main Street gets boarded up not because of a virus, but because of a currency crisis. Food prices are another critical area. Modern agriculture is energy intensive. Fertilizer is made from natural gas. Tractors run on diesel. Transport requires fuel. As the energy market delinks from the dollar and energy prices rise in dollar terms, the cost of food spirals. We aren't talking about starvation, but we are talking about food insecurity becoming a middle-class problem. The days of cheap calories are ending. The dollar menu becomes the $5 menu. This shift also affects law and order. History shows that when inflation spikes and standards of living drop rapidly, crime rises. People get desperate. Social trust erodes. The polarization we see in politics today will intensify as the economic pie shrinks. Every group will fight harder for a smaller slice. The petrodollar created a growing pie that papered over a lot of social cracks. Those cracks are about to open up. Ray Dalio talks about the internal conflict reaching a boiling point. This is what he means. It's not just people arguing on Twitter. It's people realizing that the system isn't working for them anymore because the money itself is broken. When you work hard, save money, and those savings lose 10% of their value a year, you feel cheated. You lose faith in the system. That loss of faith is dangerous for a democracy. The impacts will be uneven. Those with fixed-rate debt, like an old 3% mortgage, will actually benefit slightly as inflation eats their debt. But those renting, those trying to buy, those on fixed incomes, they get crushed. The transfer of wealth from the middle class to the asset holders will accelerate. This isn't a market correction. It is a standard of living correction. We are adjusting to a world where America is poor because it can no longer print wealth. You need to understand that this is a feature, not a bug, of the end of a debt cycle. The pain is the system trying to find equilibrium. We consumed more than we produced for 50 years. Or now we have to produce more than we consume or consume much less. That transition is painful. It means fewer vacations, older cars, smaller homes, and more work. It is the hangover after the biggest party in history. The media will try to blame greedy corporations or foreign adversaries. And while they play a role, the root cause is the currency math. You cannot cheat the laws of economics forever. The Saudis just blew the whistle. The game is up. Main Street is about to learn a harsh lesson in international financing. When your country loses its banker, the citizens pay the price. Don't expect a bailout. The government can't bail you out when the government is the one who is broke. In 2008, the government bailed out the banks. In 2020, they bailed out the economy. In this crisis, who bails out the government? The answer is nobody. The citizen ends up bailing out the government through the hidden tax of inflation. That is the reality coming to a neighborhood near you. I've painted a dark picture, but I am not here to tell you to build a bunker and hide. I am here to tell you how to survive and even prosper during this shift, because while the masses panic, the prepared investor makes generational wealth. Chaos is a ladder if you know how to climb it. The death of the petrodollar kills the 640 portfolio, but it gives birth to a new paradigm. You need to pivot your strategy from financial assets to hard assets. First and foremost, gold. I have mentioned it throughout this script, but you need to understand why. Gold is not an investment, it is insurance. It is the only financial asset that is not someone else's liability. When the Saudis accept gold for oil, they are remonetizing it. Central banks bought more gold in the last 2 years than in the last 50. Do what they do, not what they say. You should have a core allocation to physical gold, not the ETF that claims to hold it, but the metal itself, or fully allocated vaults outside the banking system. Gold is your shield against the debasement of the dollar. As the dollar loses its energy backing, gold reclaims its throne. Second, commodities. We are entering a commodity supercycle. In a world of inflation and shocks, the things that hurt consumers and high prices for oil, copper, what help investors who own them? You want to own the producers. Energy companies with long reserves, mining dig that up the copper and lithium needed for the next economy, agricultural land. These are assets that cannot be printed. When money is trash, things are treasure. Look for companies with strong balance sheets that pay dividends. Cash flow from real resources is king. Third, real estate, but be careful. In a high interest rate environment, commercial real estate and over-leveraged residential markets will crash. But fixed rate debt on cash flowing assets is a gift. If you can lock in a loan even at 6 or 7% and inflation goes to 10-15%, the bank is paying you to borrow money. The inflation eats the debt away. Look for residential rental properties in areas with strong local economies, places producing food, energy, or manufacturing. Avoid the Zoom towns and speculative bubbles. You want land and shelter, the basics of existence. Fourth, Bitcoin and crypto. I know some of you are skeptics, but listen to Larry Fink at BlackRock. Listen to the frantic pace at which institutions are building crypto rails. In a world where centralized payment systems like SWIFT EFT are weaponized, decentralized value transfer becomes valuable. Bitcoin is digital gold. It is a stateless reserve asset. As the world fragments into currency blocks, a neutral, digital, unseizable asset has a massive use case. It is volatile, yes, but a small allocation, 1-15%, is a rational hedge against the failure of the fiat banking system. Fifth, emerging markets. The U.S. stock market S&P 500 has outperformed the world for 15 years. The trend is reversing. If the dollar weakens, emerging markets usually boom. Their dollar-denominated debts become easier to pay, and their commodity exports sell for more. Look at India, Brazil, Vietnam, and yes, even parts of the Middle East. These economies are growing. They have younger demographics, and they are not burdened by the massive debt to GDP ratios of the West. Diversify geographically. Don't let your home bias sink your portfolio. Ray Dalio talks about beautiful deleveraging. It rarely happens. Usually it's ugly. To protect yourself, you must be liquid. Keep some cash, specifically termed treasury bills that roll over quickly so you capture the rising rates, but keep dry powder ready. When the panic hits, when liquidity event crashes the markets, you want to be the buyer. Great assets will be sold for pennies on the dollar by distressed sellers. That is when fortunes are made. Avoid long-duration bonds. Do not buy a 30-year US Treasury bond. You are locking in a guaranteed loss of purchasing power. In a rising rate environment, long bonds get slaughtered. Stay short. Stay nimble. Review your debt. If you have variable rate debt, credit cards, hail excess, kill it. Pay it off immediately. Sell things if you have to. Variable rates will eat you alive in this new environment. If you have fixed low-rate debt, a 3% mortgage, never pay it off early. Pay the minimum. That debt is an asset to you as inflation rises. Understand the geopolitical plays, defense stocks, cybersecurity. As the world becomes more conflicted, the external conflict phase, governments will spend blindly on security. It is a grim reality, but investing is about reality. Companies that secure borders, secure data, and secure resources will have government contracts regardless of the deficit, education, and skills. In a stagflationary environment, unemployment rises. The best hedge against unemployment is being undeniable. Upskill, learn how to use AI, learn a trade. The financialization, economy, bankers, consultants will shrink. The real economy ants, builders, engineers, fixers will grow. Invest in your own ability to generate income that keeps pace with inflation. Finally, mindset. You must accept that the volatility is here to stay. The great moderation of the last 40 years is over. Don't panic when the market drops 20%. Don't panic when headlines scream about war or currency collapse. Expect it. Plan for it. The investor who keeps his head while others are losing theirs wins. The petrodollar is dead. Long live the new system. We don't know exactly what the new system will look like. Likely a basket of currencies, gold, and digital assets. But we know the transition will be rocky. The United States is still a powerful nation with immense resources, innovation, and resilience. We aren't disappearing, but our free ride is over. We are becoming a normal nation. And normal nations have to work hard, save real money, and produce real value. Dalia's warning is a gift. He is giving you a heads up before the tsunami hits the shore. Balance of power. Most people ignore it. They will keep their 6-full-40 portfolio. They'll keep holding dollars. They will wake up one day and wonder when they can't afford to retire. You have the information. You understand the mechanics. You see the geopolitical chessboard. The shift to the yuan and gold is the signal. The breakdown of the bond market is the confirmation. The rise of inflation is the result. Your strategy must be hard assets, global diversification, debt management, and personal resilience. I've seen the world change many times, saw the post-war boom. I saw the stagflation of the 70s. I saw the dot-com bubble and the housing crash. Each time, the world didn't end. It changed. The people who clung to the old rules lost. The people who adapted to the new rules won. The rules have changed again. The petrodollar rulebook has been thrown in the fire. Write your new rulebook today. Prepare for the fallout. But more importantly, position yourself for the opportunity. The greatest transfer of wealth in history is underway. Make sure transfers to you, not away from you. Good luck. You're going to need it, but with the right strategy. You won't need luck. You'll have leverage.